So let's talk about the short-term rental loophole. Under IRS rules, rental income from residential properties is generally considered passive income, meaning that only losses from such rentals can only be used to offset other passive gains. This limits the tax benefits property owners can take compared to active business activities. However, there is an exception if the rental meets the definition of a short-term rental due to its use and the owner's level of participation. To qualify for more favorable tax treatment under this loophole, several key requirements must be satisfied. The first of which, the average rental period under IRS Regulation 1.469-1E32 specifies that the average rental period must be 7 days or less to be considered a short-term rental. This is calculated based on the actual days rented out of the total number of days available for rent. Regulation section 1.469-1TE32A basically says a passive activity is, and especially in real estate, it's going to stay passive unless you can find an exception. The exception here under Treasury Regulation 1.469-1TE32A says, hey, if you rent out your short-term rental for 7 days or less on average throughout the year, and, big and here, you spend 100 hours a year managing that property, and that 100 hours has to be more than anybody else, you can treat that short-term rental and its income and tax attributes as active participation. So you're taking it from the passive bucket over here and you're dumping it into the active bucket. That's what you're seeking to do through the short-term rental loophole. Now, where is this important? When you have two spouses, you have a wife and a stay-at-home husband, for example. That stay-at-home husband can turn around, rent out a short-term rental, spend 100 hours a year managing it, and all those tax benefits become active, even if it's just 100 hours a year. Now, mind you, this is different than the 750 hours that we talked about through real estate professional status. That's important because you don't have to achieve real estate professional status by using the short-term rental loophole. But real estate professional status requires 750 hours. This requires 100 hours. And why is that important? That's important because this only works with short-term rentals. This won't work with the house you bought down the street that you're renting out to a family of four for a 12-month lease. That doesn't work here. You have to have a short-term rental. Now, the IRS, and specifically this section of the Treasury regulations, says the average rental has to be 7 days or less throughout the entire year for which it's open to be rented. For example, if you rent out your property to a great, client out there that wants to rent the property and you let them rent it for 20 days, be very careful. That could throw off your average for the entire year. And it might not meet the definition of short-term rental. So remember, to utilize the short-term rental loophole, you have to spend 100 hours a year, and that 100 hours has to be more than anybody else. And that requires you to actively manage it. You handle the bookings, you handle the cleanings, you handle the maintenance, all the things associated with running a property. If you do all of that, that short-term rental becomes active. And that active activity can then allow you to achieve the deductions necessary to offset your spouse's W-2 income. Very important here. Very important distinction. So to wrap up the short-term rental loophole, let's talk about this. Material participation under Regulation 1.469-5T, the owner must materially participate in the rental activity, meaning regularly involving themselves in the operations and management decisions. Keeping detailed records of hours spent is important for material participation, not only in the short-term rental loophole, but in the real estate professional status. Now, the activity has to be for a commercial purpose. So by renting frequently on a short-term basis, the property takes on characteristics of a business with commercial purpose rather than a passive investment. If these two requirements are met, the rental activity is deemed non-passive under Regulation 1.4691TE32A. As such, losses can fully offset other active income like wages without limitation, providing substantial tax benefits to you and your spouse. Additionally, short-term rentals are depreciated over 39 years under the maker's depreciation rather than 27.5-year residential period. Owners can also deduct a wider variety of business expenses if you utilize this loophole. However, the rules get more complex if property changes usage. Regulations like 1.168I-4 require reclassifying assets and adjusting depreciation calculations accordingly. Failing to do so properly could result in IRS penalties. So if you take your property from a short term to a long term, it's going to be an issue. As local regulations tighten, it also gets harder to satisfy the average rental period test long term. Some experts recommend careful record keeping and consulting CPAs with rental property tax expertise to fully leverage the short-term rental loophole within the bounds of current laws and avoid compliance issues down the road. Overall, navigating this niche area of real estate investing in real estate as a whole and IRS rules requires diligent research and professional guidance to make the most of the tax advantages while remaining on the right side of an evolving regulatory landscape. I say that being a tax lawyer and knowing that I have to keep up every year with the changes in the rules. Now, as you move forward with your real estate professional status or through the short-term rental loophole, the key takeaways: 1, you must materially participate. That means no property managers. You have to do it yourself. 2, keep excellent records. I cannot say that enough. Keep excellent records. 3, hire a bookkeeper. I promise you, it is probably worth its weight in gold to get a great bookkeeper to track all your expenses associated with this. 4, consult your CPA or your tax attorney because, again, the compliance around these two rules, the real estate professional status and the short-term rental loophole, they're significant. And if you do it wrong, you could get audited. And if you're audited, you have to prove, not disprove the IRS, you have to prove to the IRS because the burden is shifted to you. Yeah, that's how the IRS works. If they say something, you have to prove them wrong. So you have to prove that you did all the things right. Now, as we wrap this up, you're going to get the entire transcript for this class, and you're also going to get the authority that I've used in this class as well. There'll be 2 separate documents. So as you work your way through this class, just understand that this is a broad overview of this, but these are the things you need to know. Also, never stop educating yourself. Education is the key to success, especially in real estate investing. Now, by utilizing real estate professional status or the short-term rental loophole, you're really going to achieve a lot of deductions you otherwise wouldn't have. Now, let me give you a strategy as a bonus here. Let's say you're a high income earner. For example, let's use a doctor. I'm here in Nashville, so we'll choose Vanderbilt. Let's say you have a doctor at Vanderbilt making $500,000 a year, has a stay-at-home wife, 3 lovely kids, a dog and a cat, right? So the wife's job, for the most part, is to handle the household and the kids and the dog and the cat. But the doctor is capped out on deductions. He can only put so much into his 401k. And quite frankly, he's a W-2. And as a doctor, he is really busy. He is very busy. Let's call this doctor a pediatric cardiologist. So very niche, making a lot of money, but no time to run rental real estate. The wife, on the other hand, who is not employed by an employer out there receiving a W-2 could actually take some of the money he's making and buy a short-term rental. And by managing that herself, she will be able to utilize the deductions associated with that tax loss and offset his W-2 income. Here's why. They filed jointly on a 1040. Well, the 1040 form, the tax form, has what is called a Schedule C, and that is where business income and deductions go. So she will be able to take the losses associated from the tax deductions from the short-term rental and put those on her Schedule C. That Schedule C will then shelter some of his income. Now let's take it a step further. Let's talk about depreciation for just a second. Imagine if wife was running this short-term rental, decided, oh, I have learned about cost segregation studies. I can accelerate the depreciation associated with this particular property and create a bigger tax loss. And in doing so, shelter more of husband's income. That is just one way lawyers like me help other people understand how the short-term rental loophole can really accelerate your investing life and allow you to keep more of your hard-earned money from your W-2. I hope you enjoyed this course. I've got several others on my website. Please check them out. And if you have any questions, please reach out via Instagram, Facebook, or TikTok. I'm happy to talk to you at any time with a consultation. You can click on the link in my link tree and schedule a consultation with me. Have a great day, and thanks for being here.